Your mortgage didn't get expensive by accident. Here's the paradox. People feel squeezed everywhere from housing to credit cards, even as wages have outpaced inflation since early 2023. On paper, that shouldn't feel like a crisis, but in real life, a typical 30-year mortgage now costs about $500 more per month in interest than it did in 2019. Credit card rates are at record highs, auto loans, business loans, all more expensive, and the frustration keeps growing. This matters to you because borrowing costs quietly decide what kind of life is affordable. They determine whether you buy a home, start a business, carry a balance, or delay everything another year. And right now, voters consistently rank affordability, inflation, and deficits at the top of their concerns. That's not a coincidence. The common story says this is just the aftermath of the pandemic, or greedy banks, or bad luck. But that explanation skips a critical driver hiding in plain sight. Since the pandemic, borrowing costs across the economy have surged. At the same time, federal deficits exploded and stayed elevated, exceeding 6% of GDP since 2023. Those two trends are moving together. But here's the part nobody is saying out loud. The same force raising government borrowing costs is quietly raising yours too. And once that mechanism starts, it doesn't stop on its own. At the center of this story is a simple but uncomfortable event. When the federal government spends more than it collects in taxes, it runs a deficit. To cover that gap, it borrows. That borrowing isn't abstract. It happens in real markets with real consequences. During the pandemic, this process accelerated dramatically. Between 2020 and 21, Congress approved more than $6 trillion in fiscal stimulus, while labor markets and supply chains were already disrupted. That money hit an economy that couldn't easily produce more goods or services in response. Demand surged, but supply didn't. This wasn't a one-off emergency that quickly faded. Since then, deficits have remained elevated, exceeding 6% of GDP since 2023. That means the government continues to issue large volumes of new debt year after year. Treasury bonds flood the market, and someone has to buy them. Here's the larger pattern most people miss. Every dollar the government borrows competes with dollars that could have gone to mortgages, car loans, or business investment. When Washington borrows more, credit becomes more expensive everywhere else. And this is where the framing changes. Rising borrowing costs aren't just about the Federal Reserve or inflation headlines. They're part of a chain reaction that starts with fiscal decisions and ends at your monthly bill. Here's the strong claim. The surge in borrowing costs wasn't random. It followed the deficit surge almost step for step. Between 2020 and 21, Congress approved more than $6 trillion in fiscal stimulus while supply chains and labor markets were constrained. Inflation didn't creep up, it skyrocketed, eventually hitting 40-year highs. As inflation surged, bondholders reacted. They demanded higher returns to hold government debt, known as higher term premia, to compensate for volatility and inflation risk. Treasury yields climbed to around 4%, more than double what they were 10 years earlier. Treasury rates anchor almost every other interest rate in the economy. The spillover was immediate. Mortgage rates rose, credit card rates climbed to record highs, auto loans and business financing followed. A $328,000 30-year mortgage now carries roughly a $2,000 monthly interest payment, about $500 more per month than an identical mortgage in 2019 or 2016. This is exactly what conventional economic modeling predicts after a sustained increase in federal deficits. Banks respond to market conditions shaped by government borrowing and inflation expectations. But notice what's missing from the popular explanation. Deficits are rarely mentioned in affordability debates. The fiscal driver sits quietly in the background. Now watch how fast this escalates. After inflation surged and borrowing costs rose, higher deficits and higher interest rates started being treated as normal. Since 2023, deficits have continued to exceed 6% of GDP, keeping upward pressure on rates even as inflation cooled. The longer high deficits persist, the more lenders expect inflation and volatility. Those expectations alone push interest rates higher today. Debt raises rates. Higher rates raise the cost of debt. The cycle tightens. The danger isn't just the numbers. It's the normalization. When elevated borrowing costs become baseline, policy responses chase symptoms instead of causes. Here's where the story flips. As borrowing costs surged, political responses shifted toward shortcuts. Instead of reducing spending, leaders promoted policies that sound pro-affordability but collide with economic reality. During the pandemic, Congress authorized trillions in stimulus. The Treasury issued massive amounts of debt. The Federal Reserve chose to absorb much of that supply rather than allow yields to rise naturally. Inflation followed, reaching levels not seen since the 1980s. After that inflation episode, incumbents lost elections driven by anger over high prices, but the response wasn't deficit reduction. Pressure shifted toward controlling interest rates. The Department of Justice served the Federal Reserve with subpoenas related to building renovations in the broader context of political pressure to lower rates. At the same time, there is a push to cap credit card interest rates at 10% in the name of affordability. Price controls don't remove risk, they hide it. Credit becomes scarcer, especially for low-credit borrowers who are pushed toward riskier alternatives. Now watch the pressure stack. Deficits remain high, borrowing costs remain elevated, political pressure targets rates instead of debt. Each move compounds the next. If rates are pushed down artificially while deficits stay high, inflation risks returning. If they aren't, affordability remains strained. This is a tightening loop. What happens if this continues? Higher debt leads to higher term premia. Higher term premia raise borrowing costs across the economy. The longer it lasts, the harder it is to unwind. Now shift the camera to you. A mortgage costs hundreds more every month. Credit card balances shrink slower. Business financing eats into margins. Higher interest quietly taxes everyday decisions. Subsidies and supply-constrained markets bid up prices instead of fixing shortages. Healthcare and education receive trillions in subsidies, yet prices haven't fallen. People feel squeezed, hear promises, and see no relief. Here's the system underneath it all. Deficit spending delivers immediate benefits. The costs arrive later through inflation and interest rates. By the time households feel it, the decision is years old. The Federal Reserve becomes the shock absorber. Pressure shifts. Blame shifts. The mechanism stays intact. Many affordability narratives ignore the fiscal driver behind today's costs. They treat symptoms, not causes. Now look at where this goes next. One path keeps deficits high and borrowing expensive. Affordability erodes slowly but steadily. The other path involves reducing deficits toward 3% of GDP, signaling lower future debt growth. Over time, that lowers borrowing costs. But that path requires difficult reforms to Social Security, Medicare, and Medicaid. Delay is easier. Markets are watching. Here's the insight that ties it all together. Affordability isn't just about prices. It's about when risk comes due. Stimulus delayed pain. Inflation surfaced it. Interest rates are now collecting it. There is no free lunch. Price controls don't create affordability. Subsidies don't fix constrained markets. Without sustained deficit reduction, borrowing costs stay high. Reframed simply, the cost of living crisis isn't only about prices, it's about debt. And this story isn't finished. The next move is already forming.